In the early 2000s, microfinance institutions or MFIs emerged as harbingers of hope for millions of underserved rural households in India, with the goal of supporting new livelihoods and promoting socio-economic development. MFIs like Basics extended small loans to low-income individuals and groups, enabling them to start businesses and secure livelihoods. Andhra Pradesh became the epicenter of this boom. But the promise of financial inclusion faltered in unimaginable ways for all parties involved. You're listening to Fail Loud by Impact Failure. In this story, we understand how the promise of financial inclusion can do unimaginable harm without a strong regulatory framework, ethical practices, and a holistic approach to addressing poverty. We unpack the most crucial learnings of the microfinance sector in the early 2000s, as highlighted in the address by former Deputy Governor of the Reserve Bank of India, Usha Thorat, at Impact Failure 2022, and Vijay Mahajan, the founder of Basics, at Impact Failure 2018. Basics' story starts with Pradhan, or Professional Assistance for Development Action. In 1983, Vijay Mahajan set up Pradhan to promote livelihoods for low-income communities. And because it was set up as an NGO, they depended heavily on grants to fund their work. By the early 1990s, lending to low-income individuals from traditional banking had dropped from 20% of bank credit to just 4%. And that's how Vijay Mahajan set up Basics, a pioneering model to promote livelihoods for these communities by unlocking access to credit through an integrated approach, one that combined financial services with livelihood support. The first 7 years of Basics were a roaring success. It emerged as one of the biggest MFIs in India and even raised private equity. On Basics' own volition, they decided to conduct an impact assessment of their portfolio.
Unlike all the world's other microfinance evaluations, ours was showing that it wasn't doing much good. In fact, only half of our borrowers, even after repaying us successfully for 5, 6, 7 years, only half of them had any significant increase in income. A quarter of them actually had a decline in income.
Until the early 2000s, microfinance was offered by not-for-profit financial institutions like trusts, societies, or Section 8 companies. Later, it became possible for for-profit, non-banking financial companies or NBFCs to take up microfinance, and foreign direct investments started coming in.
Many policy developments that Reserve Bank did were to encourage the banks funding these microfinance institutions to be able to provide the kind of doorstep services that the poor really needed.
During this time, the self-help group movement in India had taken off, particularly in Andhra Pradesh, where the World Bank had supported a project for the creation of SHGs. The Reserve Bank of India's position as a financial regulator was to allow the sector to grow on its own. However, the rise of foreign private equity changed the dynamics within the microfinance sector. Many institutions now chased high valuations and profits by resorting to bad practices in order to achieve quick growth. Many borrowers were facing effective interest rates to the tune of 70% due to hidden charges. And while these loans were intended to serve income generation as productive investments, about half the loans were taken for consumption needs, such as household expenses, medical emergencies, and social obligations. This excessive lending by giving out multiple loans and enticing borrowers with easy credit meant that the already low-income borrowers were taking on more debt than they had the capacity to repay. In 2010, an autonomous society of the Department of Rural Development of the Government of Andhra Pradesh attributed over 54 microfinance-related suicides in the state, further entrenching the public opinion that MFIs were profiteering off of the misery of the already systemically over-indebted borrowers. One of the largest for-profit MFIs at the time launched an initial public offering or an IPO. 90 days following the IPO, the then government of Andhra Pradesh stepped in and passed an ordinance making it difficult, even next to impossible for microfinance institutions to recover money from borrowers and therefore function within the state. The entire MFI portfolio in Andhra Pradesh became a mass default.
We lost a lot of money, and today it is 1% of the size that it was in 2010. And I've spent the last 7 years trying to deal with 19 banks to repay a loan of 683 crores, which the same poor people whom we had helped for 15 years and who had repaid us didn't repay us due to political reasons. And therefore, we ended up owing that money to banks.
As the sector unraveled, the RBI formed the Malegaon Committee to assess the situation. The committee introduced much-needed reforms. 75% of loans extended by MFIs were to only be given to income-generating purposes. Interest rates were capped at 24%. Penalties were imposed on MFIs for coercive recovery methods. Additionally, a borrower could not take loans from more than 2 MFIs at a time. In her address at Impact Failure 2022, Usha Thorat highlighted the failure of RBI to proactively enforce robust regulations.
RBI really not only did not bring in too much of regulation, but it also encouraged banks to lend to this because there was something called priority sector lending, and this kind of lending was treated as priority sector.
She left the audience with a few questions and valuable reflections for a financial regulator like RBI.
Was it a mistake to have allowed easy entry of private equity capital? Was it a mistake to have allowed unbridled growth without trying to see what is lying behind those figures and that growth? Did we sufficiently exploit IT-enabled controls? Was it a mistake to have allowed IPO? Was it not important to have had financial education and counseling along with microfinance? Is it a failure for the government to have provided the basic education and health needs? Has microfinance substituted government primary health and education services? And ultimately, can microfinance really be a poverty alleviation tool?
This story is a stark reminder that the promise of financial inclusion cannot rely on growth alone. While MFIs like Basics demonstrated the transformative potential of microfinance by empowering millions, the unchecked boom revealed critical flaws and competing motivations of ecosystem players. The microfinance crisis was not just a failure of regulation or business models. It was a failure to prioritize the dignity and resilience of the very people it sought to uplift. SELCO Foundation invites individuals and organizations to come forward and share their impact failure stories and to fail loud.